Well, happy Monday. It's October 9th. Want to share with you the latest data here in the Austin metro area. Wow, interest rates have been on a tear, and they are not showing signs of slowing down. If you look at the 30-year fixed right now, just in the last few weeks, we've gone up almost 50 basis points. We're now sitting as of last Friday at 7.81%. That is the highest number we have seen in 23 years. That's, every product now is significantly into the sevens. If you are borrowing money as a primary buyer, if you're an investor, start adding an 8 or a 9 to the front of that number. And that kind of tells you where interest rates have been trending. There's a lot that's been happening in the news. One of the headlines, this was from last Friday, rates surged towards 8% after strong jobs data. The spreads, what they're talking about is there's a historical spread between the 10-year and mortgage rates. It's usually about 1.75%, somewhere in there. Right now, it's about 3%, because we've got the 10-year still below 5%, and yet rates are almost 8%. So the spread is wider than normal, and some of that just reflects all the uncertainty in the marketplace. If spreads go back to normal, even if nothing changes economically or, with the Fed, what they're saying is maybe the mortgage rate can soften and come back down. But right now it's doing the opposite. It is skyrocketing. Show that to you here in a chart. Looking back at August, when we were just the last time we were below 7%. But even in September, here we are, September 1st was right around 7%. And that felt high at the time. But of course, since September, they have just been almost on a straight line up. We're now sitting at 7.8%. Very soon, if things don't change, we could see this number hit 8%. And that would be the first time we've had 8% interest rates, I believe, since the 1990s. So if you're selling right now or buying right now, neither one of you have seen rates this high in that amount of time. So here's how it's impacting the local market. This is looking at the latest data we have. This is original price versus sold price. The original price is where people started listing their homes on average, is the green, and they kind of got excited in the spring. Obviously, I've said this before, but we were listing around 531 as a market median list price back in the spring. We're now down to about 485 median list price. So sellers, you can just see the list prices have slowly just been coming down to match the marketplace. The blue line is the actual closed price. This is what buyers are buying. So our low point for this year was 430 back in February, and that was after really a strong pull down from 550 to 430, 120 grand. 120 grand. From last May 22 to February 23. Since then, we saw kind of a nice spring bounce. It went up to about 475 median price, and we're back down as of last month to about 450. So 450 to 430 would be the gap to have a flat year. So we're a little up right now on the year, but the next 3 months with these high interest rates, I would not be surprised if we continue to see some softening in the market. And more than likely, I think we might get back to that median 430 range, which means this entire year just kind of flat. Here's some additional data in the market. This is the historical sales price trend. So this is all the way back to January 2013, where our median price was $209,000. So for those of you, and this is only a decade ago, 1 decade. So we've gone from 209 up to 450. So that's 150% for those that are doing math. That's a pretty nice increase in that amount of time. But you can see it was a nice steady climb, just good economy, just going up every year, bit. And then, of course, the pandemic just took it way off the rails. Here's where we peaked last summer around 550 and then had this huge fall down to 430. But if you look at that spot to here, we're still up on the year. And so I know that surprises people, but I'm telling you, the market's just kind of hanging in there. And it's not really collapsing, and it's definitely not going up. It's just kind of hanging in there. This is a look at active versus sold listings, and this is inventory. So how many homes are for sale versus how many are actually selling per month. And again, our low point back in January, we sold about just under 1,700 homes, really low number. But the spring, we saw more and more sales. We kind of peaked out in May. Your May closings are kind of your late March, April buyers, kind of the peak of the spring market. But of course, inventory was climbing as well, and we're still kind of hovering there. We're not seeing it really drop off. I do expect we're going to see a sharper drop off as we get done with October. I'm seeing more withdrawals and expireds in the market. So I do expect we're going to see the inventory start to come back. It happened last year. I think it's going to happen this year, where some will sell, and some sellers will struggle to sell and just say, forget it, I'm going to take it off the market, or I might throw it on the lease market, although that's not easy either. I'll show you some data here in a second. But typically you start to see people say, hey, I'll try again next year. I'll keep the house. So right now we're sitting around 11,000 single family listings in the market. Last month, there's probably still some September sales that haven't been marked, but we sold under 2,300 homes. So we're approaching 4.5, 5 months of inventory at that pace. So you can see that as the interest rates have gone up, the number of sales are just trickling down in the market. And I expect that's going to continue. We might see a little October bounce. So September may come up a little bit. In August, we had sold 2,900. And right now, September is 2,200. So that's a big drop. Here is active. This is going to be the sales price to list price ratio. So where did they list the property and where did they end up closing on that property? This is pre-pandemic. Here's the 100%. So if you list at 500, sell at 500, you would have a median sale at 100% of your list price. But obviously pre-pandemic, pretty standard. You kind of see it range 1 or 2% below full list price in a healthy market. Most things will sell around there. Some will sell over, some sell under. Then we hit the pandemic, and for 2 years, everything sold at or way above list price. These two big blips are the spring when you couldn't throw a high enough number at sellers. This was like the strongest sellers market you're ever going to see right here. And then, of course, interest rates went up and bam, we have the huge fall back to earth. Literally, you went from sellers on average getting 2% over, 4% really over list price. Within 8 months, we're getting, 3% under list price. It was really hard to fathom how hard it fell last year. That was really the big adjustment. This year, kind of normal. We were averaging in the spring probably 1% off, list price. And that's final list price, not original list price. But again, it's good to look at this data just to see how do we compare to pre-pandemic. We're kind of getting back to normal. Probably a little softer this fall. We're about 2% under. But again, I think we're seeing that data kind of return to normal. All right, let's talk about rents. So this is national rent growth. This is looking on a national level. And you can see 1-bedroom and 2-bedroom apartments are highlighted in the red and the blue. Back in September, they were climbing 10%. And again, this was the end of the pandemic. Rents were really climbing, but we've seen that rent soften down to pretty much flat. And this is on a national level. So some markets are booming and are still growing in rents. Other markets are starting to see softening. So I'm going to zoom down here to, this is national versus Midwest. So where are rents growing? Nationally is this big kind of pink line going down the middle, but look at these markets going up: Minneapolis, Chicago, Milwaukee, Omaha. So what's happening is maybe some of those areas didn't have the pandemic boom, but now you've got a lot of people paying more to rent in those markets, and they probably have some supply constraints as well. So this is the full data. Wanted to get you down to Austin, and I highlighted it here. So right now, a median 1-bedroom apartment in Austin is about $1,530. Just in the last month, we've seen those rents fall about 2.5%. And from last year, they've fallen over 10%. We're at 11% cheaper than last year. This is 2-bedroom apartments. We're just under $2,000 a month, $1,950. And from last year, they've fallen just under 10%, about 9.3%. So what's happening is, and I've shown this in previous videos, Austin has built we're in the top 3 cities in America in terms of how much new supply of large multifamily apartment complexes we're putting on the market. So this is apartment rents, not necessarily single family and duplex and some of the other categories, but it will affect those as well because we are pushing a lot of inventory on the market. I think we're somewhere around 23,000 new apartment units are coming online this year. Well, those are empty. You got to fill them up. You need 23,000 new tenants to fill those up. And you still have all the other inventory in the market, all the apartments and the homes and the duplexes. And so everybody's got to compete for tenants. And so what we're seeing is we're seeing a softening in the market. On top of that, what's creating some more supply, which is kind of hard to quantify, is you have sellers that can't sell their homes or can't sell their duplexes or condos. And they're like, hey, I'll just throw it on the rent market. I'll get a tenant and I'll wait it out. Well, the problem is it's harder to get the tenants. Good example, there's a neighborhood in Southwest Austin. It's a very nice kind of upper middle class neighborhood. It's called Circle C. Big homes, not traditionally great rental properties in terms of yield, but in the pandemic, some of these homes could get 4, 5, 6,000 a month in rent. A lot of these homes now are dropping their price. Some are down to 3,200, 3,000, trying to get a tenant and they can't get one. And so they've seen huge rent declines in that area. So that's just a good example of where it's gotten a little harder to rent. So I say all this, and I can tell you we're in the meat of the fall market right now. There are still transactions happening. This weekend, we put 2 listings under contract. I've got a buyer going under contract. So there's still buyers and sellers. If you are a seller right now, you've got to be extremely conscious of the fact that there are just going to be fewer buyers in the market as rates go up. And I think you need to run a calculator and pretend you had to buy your own property and really see what the numbers are going to look like for buyers, because it is shocking how high some of these mortgage payments are going to have to be to buy properties at this range. And so as a seller, you got to be conscious of that and just know very few buyers. And on top of that, those buyers are probably, to get the deal done, those buyers may be asking for closing cost credits that are going to help them buy down their interest rate, for example. That's a very popular strategy right now. If you are a buyer, you just heard your strategy. So the number one thing I'm seeing work in the market right now is, instead of super lowballing the seller to try to make your mortgage work, it's easier to say, hey, is that property priced fairly with the comps? Do I think it's going to appraise? How can I make this more affordable for myself? Work on closing cost credits. Work with your lender. Try to put together offers where you can secure some credit from the seller if that works, so that you can buy down your mortgage rate. And more importantly, you don't have as much competition right now. So the upside as a buyer is you get to take your time. You get to go tour properties. You get to think about it. You get to run the spreadsheet again. And so that way you don't have to jump on these things the way you did during the pandemic. So hope this was helpful. A lot of moving parts. We're going to really keep an eye on interest rates this week. Are they going to touch 8%, or is something going to pivot in the market that's going to have them soften a bit back towards 7.5% or maybe lower than that? So really hard to know where interest rates are going to head. Keep an eye on all these videos. You can check all of our videos out on Ryan Kelly Group at YouTube. We post this every Monday. But until then, hope you guys enjoy your week and talk to you soon.